Ready.
Awesome. Well, hello, everyone. Welcome to our introduction to CPACE, Commercial Property Assessed Clean Energy, here in Albemarle County. Thank you all so much for joining us for today's lunchtime webinar. I'm Gabe Daly. I'm the Climate Protection Program Manager with Albemarle County. So I work in our Department of Facilities and Environmental Services, helping to reduce greenhouse gas emissions in the community, lower energy costs, energy usage, and help prepare for local impacts of climate change. And I'm joined by a number of illustrious individuals who've helped to organize today's lunch webinar, and we'll also be sharing some thoughts and ideas with you. So we have with us Ashley Davies from Riverbend Development, who's also the chair of the Charlottesville-Albemarle Development Roundtable, the impetus for the event. Ashley, do you want to maybe say a sentence just kind of in opening, since it's thanks to you that we're here today?
Sure. Good afternoon, everyone. Thanks for joining. I'm really excited to learn about this new tool that's available to our community. So I hope everyone enjoys the presentation today.
Cool. Thanks, Ashley. And thanks for, again, being the impetus for this. You're going to hear a few remarks from me. And then we also have Jason Schwartzberg and Abby Johnson here, who will be sharing a bit more detail about how CPACE works and how you can partake in it. And then we also have Ashley Hernandez from our Office of Economic Development in the county, who will say a few things just about that office's perspective on CPACE and how it can be beneficial here in the community. And you'll hear also a brief announcement and update from Crystal Rittervold, who's the director of the Office of Sustainability with the City of Charlottesville. And then we'll have some time for Q&A at the end. So without further ado, let's jump in. I'm going to pull up my screen share. All right, and maybe Ashley Davies, I see you at the top of my screen. Will you give me a thumbs up if you see the full in picture? Awesome. All right, great. Well, let's kick this off. So this is just a visual of the agenda that I just talked to. So I'll give a brief overview. Jason's going to talk a bit more in depth about really how CPACE works, some of these elements here. Abby is going to talk about the process in Virginia. And then we'll have a couple of those remarks from Ashley Hernandez and Crystal Rittervold, and then some time for Q&A. So just really big picture, CPACE, what it is, it stands for Commercial Property Assessed Clean Energy, and it helps finance improvements to new construction and existing commercial buildings that can conserve energy and water, reduce operating costs, reduce greenhouse gas emissions, and also adapt to or build resilience to extreme weather impacts. And really the idea behind CPACE is to help make these kinds of investments cost neutral for the business or developer that's making those investments. So projects can include a number of different types of improvements. This is just like a short list of areas. So solar panels, improving insulation, other kinds of weatherization, electrifying appliances, et cetera. Automating building mechanical controls. There's other things that can be done. Stormwater facilities are also included in the mix. To give one kind of a little bit more, not concrete on the ground, but slightly more specific example, a local business might use CPACE financing to install rooftop solar panels or electric vehicle charging stations. And really, ultimately, CPACE is a way to help leverage private capital in service of a lot of different types of public benefits. And so, like I already mentioned, energy savings, thinking big picture about environmental stewardship, resilience and preparedness for the local impacts of climate change. So kind of broad brush, that's what CPACE is aiming to do, and it's aiming to lower the bar to entry for making these kinds of investments for developers and commercial property owners. One of the things that I wanted to share, and I think Jason and Abby will probably go into this in a little bit more detail, but just at a very high level, the CPACE programs are intended to help overcome two common obstacles to property owners, making these kinds of improvements. We know that many of the energy efficiency, clean energy types of improvements to buildings do lower operating costs in the long term, but they can often have a higher upfront investment, right? They cost more to install, and then they save money over time. And so those two obstacles, the lack of upfront financial capital to cover those more expensive improvements or investments at the beginning, and then second, the payback period between when the upfront investment occurs and when the improvements finish paying for themselves can sometimes be too long for a business owner to feel like it's a viable option for them. So CPACE tries to address these two common obstacles in two ways. And so the first is it functions very similarly to a loan, providing upfront financial capital. Jason will talk more in detail about kind of how this piece works, but big picture, because CPACE loans tend to be very secure in how the repayment structure works, they can offer lower interest rates than a conventional loan, and so it'll reduce the overall costs. And then it also helps with the payback period. This is kind of the particular innovation of CPACE, which is that the payments, it gets into the acronym, but where it's commercial property assessed clean energy, the payments are attached to the property rather than the individual owner or business that's associated with that, or that's using that property. And so the property owner will realize the benefits of those improvements, even if they sell the property before the investment payback period. So, if you're a business and you own a building and you're growing and you want to make investments in that building, you could use the CPACE loan to do so. And then maybe you grow faster than you expected and you need to move to a new facility. And so you want to sell the building you're currently in and move on. You're not going to be bringing, that debt with you to your new facility. The new owner of the building that you were in will take on the payments for the CPACE loan and also be realizing the benefits of the energy efficiency or clean energy improvements. And then big picture, just kind of speaking on behalf of my program and the fact that Albemarle County has a number of climate action goals with respect to addressing climate change. We also have a strong emphasis on environmental stewardship. Big picture in the county, water conservation has been a priority here for decades. Biodiversity is also a priority in the county. So, CPACE is a really great way to help local businesses participate in climate solutions and local environmental stewardship. So that's my just kind of intro overview, and I'm going to stop my screen share and turn it over to Jason to get into a little bit more of the details for you.
Thanks, Gabe. I just learned a new trick from Nicole over at IT, the Control L trick. So I figure I'll try that in real time. I appreciate you having me on today. Jason Schwartzberg, president, co-founder, MD Energy Advisors, 71-person organization, strong, really focus on two areas: building owners and utilities. On the building owner side, we broker electricity and natural gas, do energy efficiency and solar projects, and have the means to finance them through programs like CPACE. And then on the utility side, we manage demand-side management programs for utilities around the country. Currently have contracts in New Orleans, Georgia, South Carolina, DC, Maryland, New York, New Jersey, actually looking at a couple of opportunities in Virginia right now as well. So excited to be here with y'all today. As Gabe mentioned, I'll grab the baton and then hand it over from Gabe and then hand it over to Abby. I'll be focused on applications and benefits, some adoption trends, implementation process, and some recent applications of the product itself for some deals that we've financed. In terms of where do we serve in the process, we are the bridge between folks who want to take advantage of the program and the capital providers. So really getting under the hood and unlocking the capital, helping folks figure out, are they a good candidate for this product? How does it work and function? Are we getting the energy reduction goals that we want? We have our engineering team to help with that. And then ultimately driving to successful closing is where we focus, for adding value in the CPACE chain. So as Gabe mentioned, I'm focusing kind of on the what, right? If you're working on and these are all projects that we've financed. If you're working on a new construction project, CPACE can be accretive. This is a self-storage deal in Connecticut. This is a senior living deal in California. This is the office building is actually Baltimore's first heavy timber office building that we were able to help finance with a piece of CPACE. And on the new construction side, for our developers or bankers on the line, I mean, this is going to work for your cost constrained deals, not necessarily your debt constrained deals. So CPACE finances clean energy components of projects, and we'll get into a case study in a moment to talk a little bit more about what that means. But at the end of the day, we need cash flow at stabilization to support the debt in the form of CPACE. So when you're doing a project, or if it's an existing project, we have to show adequate cash flow of the property to service the debt on the senior loan and in the CPACE loan. But just trying to frame, when should I think about CPACE? What are some applications? It works for new construction. It's asset class agnostic. So self-storage, senior living, office, multifamily, all of the industrial, any of the food groups it works for. You need to have energy stuff to finance, or water stuff or resilient stuff to finance as part of the capital stack. And you need to have cash flow. And we'll unpack both of those concepts a little later in the presentation. So we talk about new construction. It also works for reposition. Again, projects we've financed, upgrading a tired multifamily building and putting in a new roof, new windows, new lighting. We can finance that through PACE. This office building was a historic reposition. Again, similarly, needed a new HVAC, new roof, new windows. The medical office was an interesting example. We took an existing office building and converted it to medical office. And with that, there was energy and water content to finance as part of the project. Last one was a self-storage facility. It was an existing printing facility that could support the live loads of self-storage. And we were able to finance 20% of the capital stack of a self-storage facility, through a CPACE execution. So energy-related capital projects. You want to do solar, you need to replace your HVAC, you want to replace or modernize your elevator, or you want to look into some resiliency. I think, in real time, you have an existing mortgage on your property of 3%. You don't want to refinance that to put solar or HVAC on that project. You want to keep that strong interest rate. It's feasible. You could do a CPACE deal, and rather than paying for the solar or the HVAC out of cash, you could finance it through debt without disrupting your underlying mortgage that you have on the project. Again, energy and water stuff to finance. And then lastly, there's a retroactive component to the CPACE. If you're mid-construction, you could do a CPACE transaction to fund cost overruns. If you have a project you delivered that's a little slow to lease up, CPACE can help, replenish the operating reserves, perhaps curtail some principal from your lender to provide a little relief. So I think as you're thinking about, CPACE, where does it work? New construction, reposition, energy-related capital projects, retroactivity, and then I need energy content or water content or resiliency content to finance. And I need to be able to demonstrate cash flow that, at stabilization, my building has enough cash flow to support this debt in the form of CPACE. And for a ground up deal or a reposition, we can actually capitalize the interest as part of the loan. So if you're building one of these projects that we talked about earlier, the self-storage deal is not generating money while you're breaking ground or building it, right? So we can build in capitalized interest to support the payment on the CPACE while you're building it and stabilizing it so that the property does not have to bear the interest payment until it's generating cash flow. Basic features, it's private capital. I would think about it 20 to 30% of the project costs. If you're doing a ground up deal, again, roof, lighting, HVAC, building envelope, plumbing, windows, all of those type of things can be financed. So if it's a ground up deal, that could be as much as 20 to 30% of the capital stack. It's fixed rate. We can do interest only during construction. It has a long-term duration to it. So that's been very helpful. fixed rate, long-term, non-recourse, non-dilutive financing. And as Gabe mentioned earlier, it's an assessment that can run with the land. So it's not an actual deed of trust on the property. So we'll go through a case study in a moment, but just, rough idea. If here's a capital stack, and you're going to get 70% leverage from your senior, you as the developer and or business owner are prepared to put about 10% skin in the game. You have to figure out how to plug this other 20% gap. And you can do it through mezz, which is pretty expensive, or preferred equity, which is expensive, and it's dilutive, or they get ownership in your project. As long as you have energy, water, resiliency stuff to finance, you could plug that gap in the capital stack through a product like C-PACE financing. Adoption trends, cumulatively, there have been over $7 billion worth of deals. You could see nice hockey stick, in terms of adoption, and that's for a couple of reasons. I think one, market awareness, but Abby will touch on this a little bit more. There's a pretty heavy administrative effort that goes, into getting these programs approved in the municipalities, in the Commonwealth, in the county, in the states, because it's a special assessment on the property tax bill. So I think over time, we've been able to streamline that with statewide programs and some other things. But I can speak to, like, in the state of Maryland was a relatively early adopter. They had to go and get legislation passed in every single county in the state before they could open up the state. So I think you're seeing a nice hockey stick. I think that's a combination of market awareness and opening up municipalities. Definitely takes time. And as of today, there's programs in 38 states. So I think rough numbers, there's about 85% of the total addressable real estate market has C-PACE programs. We've transacted in a healthy number of these states. And next on the docket is North Carolina, recently got adopted. And I think the next focus is probably a state like South Carolina. But a large percentage of the total addressable real estate market has active C-PACE programs. How does it work? It's really, kind of a three-step process. We talked about cash flow, energy content to finance, and then ultimately lender consent. So on the underwriting side, we really try to make this a financial exercise at first. Can we run this through a sizing model and show cash flow at stabilization to support the debt on the C-PACE, right? Because we want to make sure there's enough cash flow to support additional layer of debt in the capital stack in the form of C-PACE financing. And a group like us or others, with 6 or 7 financial metrics, can run that from a financial standpoint. The next part is technical review. We talked about energy and water content to finance. We need to show energy savings, right? The goal for this is a reduce greenhouse gas emissions, have more clean energy projects. So there's really 2 paths. Virginia, fortunately, has this code minimum path where we have to show an improvement above and beyond existing building code or existing conditions. So if you're looking to finance 20 to 30% of the capital stack, and we're going to focus on building envelope and HVAC and water, or plumbing rather, in our example, on the HVAC, you just have to show a SEER rating that's above requirement by code, and we can finance 100% of the HVAC. That includes equipment, installation. Same thing with the building envelope or the roof. We have to show, a higher insular value than what's required. So bump up the insulation is one way to do that to promote energy savings. And then on the water side, low flow plumbing or low flow fixtures, low flow toilets, anything that can show water savings. So the path to unlocking the capital on the technical review side in states like Virginia, Maryland, it's more on this code minimum side versus an energy modeling side. So it's very prescriptive in nature in order to unlock the capital. So we need debt service coverage, we need eligible improvements. And the last bit, as Gabe mentioned, this is a special assessment on the property tax bill. So it's not a deed of trust, right? So we need to have your senior lender comfortable with the structure because this sits at the property taxes. This says 326. I think we're probably pushing over 400 lenders who have consented to C-PACE in the capital stack. And the reason you need their consent is it sits at the property tax level. You know, technically property taxes, if they're not paid, could prime a mortgage versus a deed of trust. The way that the lenders have gotten comfortable with the structure is it's a non-accelerating lien. So if it doesn't get paid, the only thing that could prime the mortgage is 1 year's property taxes, not the full loan. And I can, provide an analysis or a data point in a second when we look at the case study. So C-PACE in action. This is a deal that we financed. It was really, really cool. It looks like the Flatiron building in New York. This building is actually in the Central Business District in downtown Baltimore. It was originally operating as a bank, and you could see at this break right here, that was the original structure, and they ultimately added on to it. So this building has been vacant forever. A lot of people took a pass at it, and we supported a developer in converting this office building into about 230 units of housing. So from a capital stack standpoint, we had a local bank who was interested in doing the project. It was a total of $58 million, but their maximum loan that they could write was 20 million. They weren't able by policy to write a loan larger than 20 million. So we had to get a little creative on how to fill the rest of the capital stack. In this case, PACE was a really good option. So we'll talk about what we financed for that project in a moment, but they wrote a check for 20 million. The borrower came in with some cash of 13. This was a historic deal. So there was historic tax credit and bridge loan. And ultimately, PACE served as really good gap financing to get this vacant building, active, turned into apartments and back on the tax rolls. But for the $13.5 million of PACE, there wasn't really another source or way to finance this project. So in the examples we spoke of earlier, this would be a reposition or a value add, where you're taking an office use and turning it into multifamily, and bringing life to the street for this project. In this deal, here's the interior. It's a beautiful, beautiful building. We financed the HVAC, the plumbing, the lighting, and the building envelope. It had cash flow at stabilization to support additional debt on the property in the form of C-PACE. And Baltimore follows a similar structure that Virginia does in terms of this was prescriptive. If we were more efficient than building code on these measures, they would pass. They would provide energy savings, and ultimately we could get to the finish line on the project. Some recent trends. Again, we talk about energy-related capital projects. There are some instances where banks are looking for some pay downs. So this is that retroactive component. If you already put energy efficient content in your building, you could finance it retroactively. So these would fall into that bucket. The plug is the 210 North Charles Street deal that we talked about, where there was a gap in the capital stack. We were able to plug it with C-PACE. And it's also another example of a participation as well, right? Because we needed 58 million and the local bank was only willing to do up to 20. So we had to figure out a way. They could have participated it out and tried to find some additional lenders who might be willing to lend on the project. If you tried to finance a project right now, it's hard enough to get one bank, let alone multiple, to participate in order to get a deal done. So PACE was really helpful there. And this is me. This is Andrew, who supports us on some of our C-PACE efforts. I think we're happy to take some questions at the end of the presentation, but at this point, I'll pass the baton over to Abby.
Thanks a lot, Jason. That was great. Jason and I work really closely together, so it's always good to hear the way you describe it is very helpful, and I think it really rings true to a lot of things we're seeing these days. So let me share my screen. Okay. All right. So just to kind of bring up before I even go into who we are and everything, Jason, of the work he does around in the Mid-Atlantic and around the country, we really are encourage anyone on the phone, anyone who's interested, to work with someone like Jason, because he really helps bring everything together. So we often get calls where the program administrator, next slide, this slide, but we're the program administrator, but we can help to a certain level, but we have a lot of other functions that we do. And so we'll often say, you need to talk to someone who can tell you not only where to go, where to get the money, but also what kind of project you're going to have. Because as you can see, you have different kinds of uses, different complicated capital stacks. So it really takes a lot of expertise to be able to do that. So we really enjoy working with Jason and Andrew and his team. So we are a nonprofit called the Virginia PACE Authority that basically was created. We created it 5 years ago to basically run PACE in the state. We started with some local programs, and then a few years ago, we were able to get the state, Virginia, and statutorily pass an amendment that will allow us to run a statewide program. But because we are Virginia, we're dealing with state, and also the structure of PACE, you have to still get local governments to onboard to opt into the program. So Albemarle County is one of those localities that has opted into the program, and so PACE is active and available. So in the state, and I'll show a slide later, that's something that's required to use PACE. We have worked for many, many years in this industry. I personally worked in, I think it's like 14 or 15 states in terms of helping develop the program guidelines, the structure, just really trying to participate in an effort to make PACE work for everyone. We think it's a great program, both for new construction, existing buildings that rehab, really help in terms of our, the mission to make buildings more high performing and reduce carbon emissions and greenhouse gas. We basically have on board a number of localities in the statewide program, and I would say most of the major MSAs are now in the program or about ready to be in the program. And to date, we've closed 3 projects. We have about 200 million in the pipeline, but the 3 we've closed total over 15 million in 3 deals. So this has already been mentioned, I think, by both Gabe and Jason, but I've found that because it's an unusual concept, it doesn't hurt to at least kind of show the information again, because it's a hybrid, right? I mean, you really are talking private lender to private building owner and facilitator like Jason's company, but you also have the local government, Albemarle County, in the mix. And that is because it is a special assessment that I asked for. I, property owner, asked for this special assessment. But as a result of that, there's certain requirements that each party has to do. So I'll get into those later, but just to say, you can really structure it very creatively, but there are, public and private parties both in the mix. It's also been mentioned, again, I just put the slide up because I think it's always good to see what kind of things you can do. Virginia is a state that does not allow single family residential, like most states actually at this point, but we do all kinds of commercial. So all of them are available. And the way we determine our terms for our loans are based on the weighted average useful life of what you would, want to improve, if you want to do HVAC, lighting, things like that. I think it's also, I think Jason mentioned, the retroactive opportunity that you have with CPACE. In Virginia, we have our statute says you can do it within 2 years of project completion. The way we structured that to try to make that a little more flexible is that, say, for example, you're kind of in the beginning stages of vetting it, talking to someone about what the eligible measures are, but you don't actually have everything quite ready. We encourage you to pre-apply because that stops the clock. And then that 2 years from when you completed it, it's been met. So it doesn't have to be until you're ready with all the documents, just, from when you have a project you want us to consider. We've also, I think, mentioned this about the public-private partnership component, but I think it's really one thing to note about Virginia in particular is that we have allowed, and it's the case in Albemarle County as well, for the capital providers to bill and collect directly. Now, we're aware of it if there's a problem. We're letting them handle that component. So you won't actually get on your property tax bill a line item that says PACE like we do in Maryland. We're actually know Jason from working as administrators for another one of our companies in Maryland where it's on the tax bill. In this case, the capital provider is actually doing that instead of us. So that's something to know. But in the case of a foreclosure or any issues with it, it does, the county is involved, at least in terms of structuring, having that assigned to the capital provider to enforce. So there is still public involvement. It's just much less in most localities in Virginia. That's just the way Virginia rolls as opposed to some other states. In Virginia, as I mentioned before, you can do almost any kind of property type except 1 to 4 single family. I'm pointing that out kind of visually because I think it's important to know, like the Charles Street project in Maryland, which we were involved in as the administrator. Great project. That was a conversion from office to multifamily, but certainly if you do have an office use, you know, we can really help make it pencil better. You know, it's still a struggle right now, and particularly in the primary markets, but it's certainly, you know, been used over the years for upgrading office space. And agriculture, you know, it's not something, you know, there may be a few uses for that in Albemarle County, in some more kind of north on 29, things like that. Although I think as we see Albemarle County getting more and more built up, I'm thinking it's gonna be a lot of multifamily and maybe some assisted living, things like that, that might take advantage. But we also encourage the businesses, you know, along, you know, in the mall and areas around the mall and to consider PACE, or, you know, in Albemarle Square, things like that, you know, some of those shopping centers. We also have a property developer on as part of our team here presenting. So, you know, she probably can speak to that as well. But that's Virginia. As Jason mentioned, we're very broad in terms of our eligibility of what you can finance. It's interesting because we basically have expanded the program every year. We started with energy efficiency, water efficiency, and renewables. And then we saw the need in Virginia, particularly for resiliency and EV charging, because we're not a state that has as many incentives for that, to try to make that eligible. You know, resiliency can be maybe something more obvious as like flood mitigation. I'm gonna go to the next slide for that, actually. But it can also be things like backup generation, backup generators, things like that, or even, it wasn't a big, you know, earthquake, but there was a seismic event that Charlottesville did feel, maybe it was like 10 or 11 years ago, I remember. You can do it for wind, you can do it for riverine flooding, you can do it for, you know, just even impacts of some applications related to fire protection. And then also we added environmental remediation, which we think is really great for some of the historic older buildings. You could find some of them in the county, and certainly in the city of Charlottesville. We have Crystal here with the city. So just keep that in mind as when you're doing a rehab, you have your historic tax credits, you have, you know, as in that one example that Jason showed, there's maybe applications to do some of this remediation that PACE could pay for. And I think also something to note is stormwater management, which, you know, it's still part of the Chesapeake Bay Basin. A lot of the requirements in this area in Central Virginia. And so being able to mitigate some of the costs or finance some of those really, I think is something to keep in mind when you look at your new development. Here's where we are today in the state. And every time I put this slide up, I'm like, oh, we have so much white, but it actually represents about, I think it's 47% of the population at this point. And we have another 8 to 10 jurisdictions that are like in the hopper, and we anticipate in the next year, maybe even 9 months. So I think, you know, it's a lot of pretty crescent feeling here, with the addition of a few localities in the West. But we definitely, it really shows a lot of what we do is outreach to localities. We certainly want to talk to developers as well, because they actually often developers are kind of what leads and drives locality to pass an ordinance, but definitely we have a lot of cities and counties, but we're excited to work with all of them. And our pipeline is really robust right now. A lot of them are new construction, a few are retrofits, but a lot of new construction, because as Jason pointed to, we do have issues with gaps in financing always, but I think right now it's particularly present in the market. And this is not just in Virginia and Maryland, this is nationwide. So basically, you know, I mentioned the fact that we had local programs, now we have a state program, and why we're excited that Albemarle County, you know, decided to join our state program is because it really helps everyone. It helps us in terms of having one set of guidelines and program to run, but honestly, it really helps with the developers who really just want to look at one program guidelines, not 14 or 15. It helps with, you know, MD Energy advisors when they're trying to vet, you know, the technical side or develop the program. You know, what can we do in this building? If I have to think, well, in Albemarle it's one place, and Charlottesville it's another, and Richmond's another. I mean, it just becomes really overwhelming and really maybe not worth the effort, because it's just, you got to go where it's the most consistent. And the same for the capital providers. They really often have to get legal opinions on the loans that they are actually making. And when they do that, it's an expense to have to go around. So we're very excited that we have this central set of technical standards, program guidelines, outreach materials, and legal documents, transactional and legal and administrative documents. So that is the structure we've created, and it's been working pretty well. As we've seen, you really see when you start closing deals, if there's some things to tweak. And of course, there are always things you can tweak, but so far, so good. And just wanted to show you, certainly can link it in the chat after I finish presenting where to find our list of documents. We divide them up between programmatic documents, which are things you would see pretty much in every locality, and transactional. So if you're a developer and you want to use PACE, you'll see the documents that some of which you have to use in every transaction. Some will depending on whether you are mending something later on down the line. But this is where they're all housed, and we're happy to answer any questions you have on those documents. So sorry for that. Let's see. So then we have what the locality does. Locality basically, and Albemarle has already enabled the ordinance. And so they're already in the program. They've already executed the locality agreement. What we're waiting to do, we're excited to do, is to basically have a deal in Albemarle County that we can close together, and that can basically that the county will review the documents they've already seen. We'll look, basically vet we'll beginning to end. We'll take in the application. We'll make sure they've done everything they're supposed to do per our guidelines. They made sure they've completed everything in the checklist. This is something also MD Energy Advisors and the capital providers help with for developers. Then we would, vet to make sure that the documents that they provide us have been, not modified, except for like the kind of details, the loan details. And then we would send them to the county attorney and to Gabe to review them and to sign them. So that's really where you see at this point, once you've opted in, when the locality needs to be involved on a typical process. But of course, we love in situations like this to partner with the county. And we're very happy that they've been very active partners in that regard. So, and then this is just kind of a list of the things we do. I mentioned a lot of them already. So, this is something, gamut from kind of the public side, taking new localities, providing outreach, to making sure that the project that's come in conforms, and working with the stakeholders who bring us projects to make sure they understand the requirements so that it makes it, smooth sailing once we get in the docs. So working with folks that, understand PACE certainly is helpful, but we're also happy to help bring anyone up to speed who wants to work as a contractor or as a project developer or as a capital provider. We're here for that as well. So this is just the application process. It's basically, you go to our website, you go to apply here under whomever you are, property owner, contractor, or lender. And once you do that, you just fill up a pretty simple form. And then we really encourage you to either find a capital provider to help you with determining your project elements, or, really someone like Jason's firm, MD Energy Advisors, will do that as well. They'll really help you, vet what your project is and also figure out who's the best lender. We can do it to some extent, but as you see, we have to get all those white areas filled in. So we leave it to to experts like Jason to do that. And then once you fill out all the application information, we will review it. And we're really quick, we get all the information. Once we have the information in, we'll review within a few days. We really are trying to make this something that works well. I would say the things that probably hold up a deal the most, we get a call at that, is just making sure we're ready to go in terms of lender consent and making sure that we have all the documentation. But once we have that, we're really good to go. And this is just really quickly, and I'll want to be short because I want us to have time for questions. We've closed 3 projects. This is a gut rehab we did in the city of Petersburg, Virginia. And it's a really exciting project in that it had lots of different sources of financing. And as Jason alluded to, you can really, PACE really works well with other kinds of programs. So they had like an industrial development grant. It had a tourism component. It had historic tax credits. It had a loan from the local EDA. But it was a complicated project to convert a building like this into a hotel, a flagged hotel. And so there was a gap, and PACE filled that gap with, you see the kind of measures it used. The other example I was going to bring up is new construction. Basically, there was a gap as well. in that when we were building it. And so similarly, they were able to pull out measures that would qualify. And as you can see, it was a very long term. I mean, it's very hard to find a term like that unless you're HUD or Virginia Housing. For those of you who know our housing finance agency, these kind of terms, are really PACE is unique in that way. This is a much larger transaction. So with that, I'll leave it there. I will see our information, basically our first names and then virginiapace.com, Abby, Ellen, and Andy. Happy to answer any questions during the Q&A. Thank you.
Abby and Jason, thanks so much for those, all that really great information. I want to hand it over to Ashley and Anarena to just speak briefly from our Economic Development Office perspective. And Ashley, those two other example projects that we wanted to send out, I can't quite drop them into the Zoom chat. So we'll include an after action email to everyone who's here, as well as everyone who registered, but maybe couldn't make it, so that folks can take a look at those.
Thanks a lot, Gabe. I appreciate it. Yes, those two examples that we'll share later are some really innovative examples of how to implement this type of financing and this resource that would really be a great match for our locality and our community. But we ultimately just want to be here to support this initiative and to confirm that the Economic Development Office here in Albemarle County, we really want to support new investments in our community, and especially those that are new or expanding businesses. It's a real enthusiastic position we take to help those businesses in any way that we can. And it's an even easier sell if in some way that benefits the environment and reduces greenhouse gases. And this financing tool, it's having obviously so much success around the country with helping projects get completed. We receive requests a lot about how to access capital in ways that businesses and developers can get their projects completed. And this is such a fantastic example of a way to do that successfully. Those two examples that you were referring to that would be suitable for our community, we can share after the webinar. You can either reach out to our office, our Economic Development Office, or they'll be included, I'm sure, in follow-up communications after this webinar. But they just provide kind of an overview of the role that the type of C-based financing played in these projects that could happen here in Albemarle County in Central Virginia. One that was really successful was a build-to-suit space for a biotech manufacturer in Minnesota. And they essentially incorporated the installation of some really high-efficient equipment, and the C-based financing helped them to complete that. And then another was an industrial building expansion. They essentially added 36,000 square feet of production and warehouse space and utilized some solar energy equipment to really reduce their carbon footprint. And those two examples combined resulted in, I think, over 30,000 metric tons of CO2 reduction in their process. So that's a huge impact, and we're really enthusiastic about getting behind that kind of stuff. So just wanted to reinforce that we'll just be happy to connect with anybody that's contemplating a project like this, and just connect with us, and we'll make sure that we can help you guys cross the finish line and investigate that avenue of financing. But we're always available to answer any questions. Appreciate being a part of it.
Ashley, thank you so much for giving that overview. And I think you mentioned that those types of projects are particularly good ones to think about in the mix for Albemarle County. It's like, I think about the county's target industries that are, talked about in the economic development strategic plan, in our comprehensive plan. And so we'll send out the fact sheets that give a little more info about those kinds of projects, along with the great examples, that Abby and Jason also shared.
I'd love to add too, Gabe, that, we've talked about how fast Albemarle County is growing and the development as it occurs. And we also have a building reuse grant that we utilize within the organization and with the county, just to incentivize these types of climate friendly development opportunities, because we only have so much space. And there are buildings that exist that could benefit from this type of capital financing too. So that's always something to consider as well.
Thanks for mentioning that. And we talked about,
Yeah.
doing another info session or announcement about that grant opportunity to get into more detail. No, well, I think I'm glad you mentioned it as a teaser, and then folks, we might even need to have some more time to explore it. So I think there's a number of different ways that folks can get financing, for example, to do, the redevelopment or repositions that Jason and Abby were talking about. So yeah, thanks for mentioning that, plugging that here as well, Ashley. Crystal, do you want to just share something brief about, I know the city is interested in exploring CPACE as well, so we can kind of fill in the donut hole in the whole area. Do you want to just let folks know about kind of where the city is in its process?
Yeah, sure. Thanks, Gabe. Thanks for inviting me along. It is nice to be the donut hole in this conversation. The city of Charlottesville, we have been tracking CPACE for many, many years. And I just want to sort of reiterate what Abby said, is the complication of trying to set up individual programs in every single locality and have different administrators and have different rules is really one of the reasons Charlottesville just kind of sat on it for a while, and have been very excited to have this statewide program option. And I'm excited to say that we are going to be bringing that ordinance to our city council late September. And, I think that there is similarly many different building examples of, particularly, I think, reuse or expansion or renovations. Our office, the Office of Sustainability, wants to see as much solar, as much energy efficiency, as much resiliency in our existing and in the new buildings. So having this conversation, having an awareness of property owners or developers or finance entities who are interested and are willing to sort of express that and share that. And, it'd be great for a city council to hear from the community about interest in having another really good tool in our toolbox. We adopted a climate action plan in January of 2023, and looking at effective financing mechanisms to support climate work is one of the key actions in there, with CPACE being specifically called out. So we're looking forward to get this over the finish line and be one of the communities in the statewide program. Thank you.
Awesome. Thanks so much, Crystal, for sharing that update from the city. We've got just over 10 minutes for some Q&A and discussion. And I see, Abby, thanks so much for answering so many questions in the Q&A for folks. I wonder, let's see, there was one question that came up that's in the Q&A I'll ask, and then I have a follow-up question actually about one of the ones that Abby answered. So someone asked, I think, Jason, this is probably for you, what about the negative arbitrage to the developer, interest on interest? I think that was probably from something you said. Maybe you can speak to that.
Sure. Yeah, no, I think that was a 300 level question, but happy to answer it. So, similar to equity, PACE is funded day one, right? So if you have equity in the cap stack, you're paying interest day one on the equity. You're also paying interest day one on the PACE when it's financed. When it's funded, there's some ways to curtail that. For a large enough deal, tranching is an opportunity where maybe, the loan gets tranched and doesn't all get funded day one. I guess to back up two steps to the 100 level, the PACE gets funded day one. When the transaction closes, when the cash goes into the deal, interest starts to accrue. So the question is pushing on the idea of the interest is starting to accrue. All of the capital isn't available on day one because it goes into the project when the energy related content gets placed in the service. So that's the thought pattern there in terms of the neg arb or the interest on interest. But when you take equity from a developer, if you're LP in a deal, that gets funded day one too, and that interest starts to accrue. The benefit of PACE is you're not giving up ownership in your property where you are with equity, so they're getting a preferred return and ownership. But there are some ways to minimize. One, tranching is an opportunity. Two, which is probably an even easier structure, if the PACE is funded day one, we can put it in your bank that's funding the construction loan. You could request that it be put in an interest-bearing account. If it's put in an interest-bearing account, it has the ability to minimize the amount of interest that you're paying on the project. So it's better than equity because it's not dilutive. It does get funded day one, and there is some optionality. If the loan's large enough, you could tranche it. If it's on the smaller side, you could put it in an interest-bearing account to try to minimize the amount of interest that you're paying. But at the end of the day, it's going to be more accretive than equity going into a project.
And I just wanted to add to that from a programmatic standpoint, we have sometimes people ask, well, are you going to allow that? And as long as it's still living within the letter of like the spirit of the program, we think that's fine. That's great. We really want to try to make it cost effective. So we can do that in Virginia. So
cool. One thing for folks who are following along, check out there are some answers to questions in the Q&A if you're interested in the answers to those. We'll also include them in our follow-up email to everyone for folks' benefit. Abby, it looks like you're typing an answer, but maybe you can just say it.
Yeah, I think
Chris asks,
that one. Yeah,
for utilizing this retroactively on projects, is the 36 months from Jason's slide deck a hard cutoff? Do you want to just maybe speak to that?
Yeah, exactly. So most states it's statutory, not every state, but in Virginia it is. So it's not really, unfortunately, a choice. We would like to potentially extend it to be more than 24 months, but right now in our state law, so every state has a state law and then you have local laws. The state law gives us 24 months. So what I said earlier was that if you can put in your pre-app right now, if you have a project, even if it's not completely baked in terms of finding your financing or completing all your drawings, we can stop the clock on our end. And then you have the 24 months. I guess you've already done your project, but if you say, I wanted to pull out these projects and I'm working with a lender, stop it now because that 24 months is statutory.
Okay, thank you. Another question, how will, this is from Coles, how will CPACE overlap and or benefit from the pending GGRF programs, for example, green banks and green lending from CDFIs? I'm hoping that a couple folks know those acronyms because I don't.
I could probably, I get this question quite a bit. Do you think that CPACE will even be used now that you have all the greenhouse gas reduction fund monies coming in? It's the big infrastructure Inflation Reduction Act, as part of that. And we think that they'll work well together because, and I'm not an expert on that, and maybe others on the call can speak to it even in more detail, but there are certain requirements in many cases like Buy America or Davis-Bacon where you have prevailing wage, which may make some components of development projects have more affinity towards PACE. Of course, these are grant programs, so their money is, it's obviously more followed. It's not a private transaction, so you're getting that much. It's not, you have to pay it back. It's not a loan, but I think it's going to be really complementary. And then CDFIs are really community development finance institutions, and they're going to be using PACE. I think it's going to be a lot in the kind of low-income housing arena, which I think is great because CPACE still really regarding like LIHTC, low-income housing tax credits, or HUD. It's still not that easy to use those for. I'll just say that right now. We're trying to get that going in Virginia, but that's a much more complicated way of getting those financed. So I think if that can, those monies can be used for that, CPACE can stay more in the commercial arena.
Cool. Thanks, Abby. Another question from Evan. What is the DSCR required?
Yeah, so I think DSCR is debt service coverage ratio. It's basically comparing cash flow of the property versus debt load. And typically you want to make sure there's excess, just like your household budget. That's going to really be driven by the senior lender. Because we're going to ultimately need lender consent. And I think it's important. We talked of the three there's hurdles to every project, but the main three hurdles, underwrite, technical review, lender consent. A group like ours can take care of underwrite and technical review in-house. Lender consent, if you have a senior lender that you're working with, you want to start having those conversations as early on in the process as you can. have they done a PACE deal? If not, how do we educate them? The majority of them, when they understand that the loan can accelerate, again, if you did a $10 million PACE loan and the annual payment is $800,000 and it's not paid, the only thing that could prime the mortgage is that annual payment, not the full 10 million. But to specifically answer Evan's question, we typically run it at a 1.25 debt service coverage ratio when we're sizing it. If your lender's willing to go lower and give us consent, like we can go lower and get consent. But I think 1.25 is probably a safe number.
Cool.
And that's stabilized. Sorry, that's stabilized NOI. So you're 1.25 off your stabilized NOI.
Thanks, Jason. We got just a couple minutes left. I'll have like one sentence of closing, but I did want to ask a follow-up to one of Kimberly's questions around single family homes, which I think, Abby, you answered. This is really, so it's commercial property assessed. So it's for, commercial can include residential if it's 5 or more units. But I am curious for townhomes or condos where the units are individually owned, would it be considered commercial if the developer in developing that building, if they're attached, before the individual units are then sold off? Like if it's new construction and they're attached dwellings that will ultimately be sold as condos or townhomes rather than rented out as apartments, would it fall under CPACE or be eligible for CPACE during the new phase?
Yeah, that's a great question. And the answer is yes. We have a stricter law than some states in terms of saying no condos, no common area condos for residential condos, not commercial condos. But we certainly are, if it's zoned commercial or non-single family residential, non-condo, and you're developing it, we're allowing it to be, we and the lenders, they have to agree to this too, to pay it off as you go along. It's pretty complicated to do that, but we're, because that means you have to structure the amortization schedule and all this, details, and maybe Jason's done some of those, but we're looking at one deal right now in another county. That's how it's going to be structured, that as the condos come online, they will then, that part of the PACE assessment will go away because it's not allowed. But for new construction, it can work, just a little more complicated than other types.
Okay.
Yeah, that's right. And if you're considering build to rent, like we have town-owned projects that are built to rent, we've helped finance those projects as well. But
Sure.
yes, to Abby's point, you can do it on the front end and you just pay down the PACE when you're, this is probably the wrong legal term, but when you're handing title to the individual condo owner, you can pay down the PACE when they're taking title to the project. So it doesn't trip the residential issue.
Yeah.
Cool. Thank you. That's really helpful. I do see that Cole's had another question in here that looks like a good one. We're out of time. So what I'm going to do is maybe I'll send this one to Jason and Abby for your consideration after the fact. We'll put together a Q&A sheet to go out for everyone who's interested, and then we can follow up with you all so that you can have this information at your fingertips. We also have recorded this, so we'll be sharing out the recording. If there are, friends or colleagues in the, business and development community in Charlottesville who couldn't make today, but you think would be interested, please feel free, once we have that recording and the information packet that we'll send out, share it with your friends and colleagues, business partners, et cetera, in the community. We're really excited about being able to promote this opportunity. I'm guessing it's going to be somewhat like solar panels, where when the best predictor of whether someone will put solar on their rooftop is seeing other neighbors with solar on their rooftops. And so I think if we can, kind of get these projects going here in Albemarle County and also in the city of Charlottesville, the more projects that happen will beget more projects, and we'll realize the community benefits and benefits to property owners associated with that. So it'll be a snowball effect, we hope. So thank you, everyone. Thanks to our panelists and organizers for being here, for your time and effort and good ideas, insights. And thanks to everybody else for joining us. Stay tuned for more, and we'll see you next time.
Thank you.
Thanks.